Welcome to our comprehensive guide on North Korean tax residency. Understanding the intricacies of tax residency in North Korea can be daunting due to its political and economic isolation. This guide aims to demystify how to establish and maintain tax residency in the Democratic People's Republic of Korea, or DPRK. For those considering tax residency for business, diplomacy, or other motives, grasping the unique legal framework is critical. Given the limited information accessible on North Korea's tax system, we aim to present a clear overview to help navigate these complex waters. The legal framework surrounding North Korean residency is distinct and tightly controlled. It is based on the principle of juche, or self-reliance, which deeply influences how foreign nationals are treated. Unlike Western countries, where residency may be granted through various straightforward means, North Korean residency is often reserved for select individuals, including government-sponsored workers or diplomats. Navigating the bureaucratic maze to secure residency involves applying through numerous government channels, highlighting the need for prospective residents to understand the specific categories governing residency eligibility. Central to North Korean tax residency is the 183-day rule, similar to many international tax systems. In North Korea, if you spend at least 183 days in the country within a calendar year, you might be classified as a tax resident. However, meeting this physical presence threshold isn't a guarantee of obtaining residency status. The North Korean government possesses the discretion to grant or deny residency based on its approval processes. Therefore, understanding the nuances beyond mere presence is essential for anyone looking to establish residency here. Tax obligations for North Korean residents differ significantly from international norms. The income tax system is based on a centralized model, where most enterprises are state-owned, and wages are set by the government. Foreign residents often face different tax rates, particularly if they work in special economic zones, which operate under unique regulatory frameworks. Additionally, reporting requirements are stringent. Foreigners typically do not use self-reporting systems but must adhere to protocols administered through their employers or government entities. Therefore, familiarity with these obligations is vital. Lastly, when establishing tax residency in North Korea, navigating the entry requirements can be an arduous process. Unlike most countries, a standard tourist visa does not pave the way to residency. Applicants must work through designated tour operators and government agencies for entry permissions, which may involve rigorous application protocols. For those who are granted residency, keeping track of physical presence days becomes crucial for compliance with the 183-day rule. Using tools like Pebbles to monitor residency days can be instrumental, but it is only part of a much larger compliance landscape. Understanding these layers can help officials and businesses maneuver within this unique